You buy the resistance breakout, and the price immediately drops. You short the breakdown, and the price instantly spikes. The violent whipsaws we are seeing across the crypto market right now are meticulously designed to drain retail accounts. Institutions execute these deliberate, calculated liquidity hunts to clear out retail stop losses before initiating a true directional move. Welcome back to Crypto Whale Radar. Our objective is to strip away the emotional noise of the market and read the raw mechanical data that institutions use to position their capital. Over the last 48 hours, market makers have neutralized the immediate liquidity on both the upside and the downside. We are now operating in a strictly defined neutral trading zone. By the end of this video, you will have the exact institutional price targets for Bitcoin, Ethereum, Solana, and XRP, allowing you to stop guessing and start executing with precision. Surviving this specific phase of the market cycle requires you to abandon traditional retail breakout strategies and strictly adopt the logic of the market makers trading against you. Bitcoin perfectly hit the exact 69,000 to 69,500 bearish target we mapped out in our previous analysis. The price bounced precisely from that immediate support zone. This diagram shows the recent price action. The drop to 69,000 mathematically cleared out downside liquidity immediately following the massive upside sweep. With both ends wiped clean, the structural state is a neutral, range-bound chop zone locked firmly between 69,000 support and 72,000 resistance. Above the crypto market, we have to look at the multi-week weakness in the S&P 500. This overarching macro downward trend acts as a heavy ceiling, actively suppressing risk-on assets across the entire board. We are seeing a minor short-term daily bounce occurring in the stock market right now, following consecutive days of pullbacks. This short-term equities bounce provides localized relief for Bitcoin, keeping it afloat above 69,000. It does not indicate a true macro trend reversal. Because the immediate liquidity is cleared and the macro economy remains weak, trying to front-run a massive breakout right now is a trap. The only statistically viable strategy is trading within the established range. The trap currently destroying retail accounts is a concept called timeframe divergence. Timeframe divergence is the structural conflict that happens when short-term indicator signals suggest a bounce while long-term trends remain heavily downward. This chart shows the 4-hour timeframe, where Bitcoin is printing a near-oversold RSI signal. The RSI, or Relative Strength Index, measures the speed and magnitude of recent price changes. This specific 4-hour signal indicates a short-term bounce. When we zoom out to the weekly chart's massive bearish divergence, that short-term bounce becomes practically invisible. The macro downward structure dictates the larger path. Buying a 4-hour bounce does not invalidate a multi-month bearish trend. Expecting a small relief rally to break all-time highs is a severe miscalculation of market structure. However, trading the 69,000 to 72,000 channel is a highly profitable scalping opportunity, provided you execute trades on a platform designed for tight margins. For institutional-level execution, I use the 2-bit exchange. It requires no KYC, and right now, using the link in the description secures you a portion of a 3.5 million USDT prize pool, plus up to 200 USDT in withdrawable stablecoins just for setting up your trading account. Indicator signals mean nothing without timeframe context. Confusing a micro bounce for a macro reversal is the fastest way to blow your deposit. Looking at the rest of the market requires checking Bitcoin dominance, which has been trapped in a sideways consolidation for multiple months. Bitcoin dominance is the ratio of Bitcoin's market capitalization as the total cryptocurrency market cap. This diagram illustrates how a flat Bitcoin dominance mathematically forces major altcoins to mimic Bitcoin's exact percentage drops. When Bitcoin sneezes in this environment, altcoins catch a severe cold. We see this clearly in Ethereum, which has structurally failed to hold its critical 2150 to 2250 golden pocket. The golden pocket is a specific Fibonacci retracement zone between the 0.618 and 0.65 levels that frequently acts as a heavy support or resistance floor. Having broken below that floor, Ethereum now faces a heavy, suffocating area of resistance looming directly overhead between $2,200 and $2,400. XRP is displaying an even clearer technical warning with its massive, uninvalidated weekly bearish divergence. A bearish divergence occurs when an asset's price records higher highs while its momentum indicator records lower highs, signaling a weakening trend. This weakness resulted in XRP's harsh precision rejection directly from the $1.60 Fibonacci resistance level. A Fibonacci resistance level is a horizontal threshold based on mathematical sequence ratios where price momentum historically stalls. Following that rejection, XRP broke below previous resistance and is now relying on an immediate critical line of defense, sitting exactly at the $1.43 to $1.44 support band. ETH and XRP are currently performing as leveraged shadows of Bitcoin, with macro correlations overriding their individual network utility. Solana is following the exact same subjugation. Its multi-month bearish trend remains active, and it has not yet printed a confirmed reversal signal on the larger timeframes. Over the last few days, Solana perfectly rejected from its long-standing, heavily defended resistance box located between $95 and $105. Having confirmed a breakdown below short-term support, Solana's precise downward targets are now resting at $86.70, with secondary support at $84.50. Chainlink is showing strict price containment. It is maintaining a reliable support floor resting entirely between $7.90 and $8.50. This visual represents Chainlink's current structure. While the support holds, the asset is trapped by a psychological ceiling and heavy resistance at exactly $10. Across all major altcoins, overarching market weakness dictates the strategy. Institutional traders are waiting for the price to hit the extreme edges of these ranges, completely ignoring the middle range chop. To navigate this specific market geometry, you must formalize your strategy by adopting the Whale Radar action plan for the upcoming week. Hit the subscribe button and join our closed Telegram community using the link below. That is where I provide real-time institutional setup adjustments as the live data updates. Market structure currently favors patience over aggression. Avoid front-running the breakout. Trade only the extremes. Long the 69,000 support, short the 72,000 resistance, and maintain that discipline until a 3-day candle definitively confirms a new directional trend. While trading the range is required today, failing to recognize the eventual macro trend shift when it arrives is the next fatal mistake you can make. Click the video on your screen right now to discover the exact macroeconomic trigger that will violently break this current range, and I will see you there.